Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day. In this video, I am going to walk you through the process of valuing Procter Gamble stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Procter Gamble is a consumer goods company with headquarters in Cincinnati, Ohio. It was founded in 1837 by William Procter and James Gamble. It specializes in a wide range of personal care and hygiene products. These products are organized into several segments, including beauty, grooming, healthcare, home care, baby, and family care. Let's get started with the model. This is a large cap company, 331 billion market cap. They're trading at $135 a share, and they have 2.5 billion shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. The company has lots of free cash flow each year. It's improving as well, from 11.2 billion to 15.1 billion. Net income is the profit and loss on the income statement, and that also grows quite a bit from 9.5 billion to 13.5 billion. Revenue is the sales for the company, and that grows every year as well, from 66 billion to 72 billion. They also have pretty strong margins. Net profit margin is net income divided by revenue. It's how well you convert revenue into profit. They converted 19% of their revenue into profit in the trailing 12 months. Which means 81% went towards expenses. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue, and that was 36 billion in the trailing 12 months. Below that is gross profit, which is revenue minus cost of revenue, and that was the highest in the trailing 12 months at 36.8 billion. Then you have operating expenses. Then below that is operating income, and that also seems to be growing every year. So everything looks really good so far. The company had $386 million of interest payments on their debt, and then they have other income and expenses of $500 million. Below that is pre-tax income. The company has to pay taxes based off of their pre-tax income. The bottom line of the income statement is their net income, and that was the highest in the trailing 12 months at $13.5 billion. The reason their net income was so low in 2019 was an $8 billion impairment. Impairments show up in other income and expenses. An impairment is when you write down the value of an asset and pass through the expense onto the income statement. But that's a non-cash item because you actually paid for the asset in the past. You're just decreasing the value of that asset. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. Then you have capital expenditures, which are investments in property, plant, and equipment. Operating cash flow minus CapEx equals free cash flow. And that was the highest in the trailing 12 months at 15.1 billion. So the company has lots of free cash flow to work with. A company can use its free cash flow to pay a dividend, buy back stock, pay down debt, or invest back into their business. This company does pay a dividend, but it also buys back lots of stock. It bought back 7 billion in 2018, 5 billion in 2019, and 7 billion in 2020. Buying back stock rewards shareholders by decreasing the shares in the market, making the current shares more valuable. The company also issued lots of debt in 2018, 19, and 20. It issued 5 billion in 2018, 2.4 billion in 2019, and 5 billion in 2020. It did repay some debt, but not nearly as much as it issued. The most important part of any business is their operating cash flow, and this company generates lots of operating cash flow. Remember in 2019, they had only $4 billion of net income, but they actually generated $15 billion of cash flow because net income is accounting profit and loss. The company passed through an $8.3 billion asset impairment. So they decreased the value of their assets on their balance sheet $8.3 billion, passed through an expense of that amount onto the income statement. But we have to add it back on the cash flow from operations section since it's a non-cash item. The company also has about $3 billion of depreciation every year, so we have to add that back on the CFO section. Let's look at a capital structure. $47 billion of equity, $36 billion of debt, and they're 57% equity, 43% debt. Their net debt is $19 billion. So if they used all the cash on their balance sheet to pay down some of their debt, they would have $19 billion of debt left over. Their WACC is 6.2%, and that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 4, that's $442 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $401 billion. We divide that by 2.5 billion shares. And we get a calculated stock price of 162. They're trading at 135, so they're trading at a 17% discount. It's a buy according to the model. Simply Wall Street values the company almost exactly what I value them at, 162. That's really interesting how close we are. So the stock has pretty much only gone up the past 5 years. It did take a little dip here and there, but overall it's gone up. It looks like it did peak in the low 140s. The company pays a 2.3% dividend yield. To calculate the dividend yield, you just take the sum of the last 4 dividend payments, then divide that number by the stock price. They pay out 58% of their net income and 51% of their free cash flow. Here's an article from today. The title is P&G raises its forecast after earnings top expectations. So second quarter revenue jumped 8%. So this company is benefiting a lot from the COVID pandemic. This company has a really low beta, 0.38, so the stock moves much less than the market. The stock has increased 7% in the past 52 weeks, much worse than the S&P 500 of 13.5%. The low was 94, the high was 147. And the stock is trading below its 50-day and 200-day moving average, so it seems to be on a downtrend. About 6 to 7 million shares are traded each day, and all the shares outstanding are on float. 2/3 of the shares are held by institutions, and less than 1% of the shares are shorted. If you invested $10,000 into this company 10 years ago and reinvested the dividends, you'd have $28,000 today. If you did not reinvest the dividends, you'd have $24,600 today. So if you invested $10,000 in January 2011, it looks like the longer you held, the better off you would have been because the stock price kept going up. Their biggest shareholder is Vanguard at 9%, then BlackRock at 6.5%, then State Street, Wellington, and Geode. Let's look at the financial ratios. The average PE in the market's 10.8, the median is 14.3. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They're at 24.9. So investors are paying $25 for $1 of earnings. Price to sales is stock price over sales per share. They're at 4.6 between the median and average. Price to book is stock price over book value per share. They're at 7.1. The way you calculate book value per share, it's equity over shares outstanding. Equity is assets minus liabilities on the balance sheet, and they have $47 billion of equity. Their tangible equity is negative $18 billion because they have $64 billion of intangible assets on their balance sheet, $40 billion of goodwill, and $24 billion of other. Interest coverage ratio is EBIT over interest expense. They can easily cover their interest payments. ROE is net income over equity. They have a great ROE at 29%. Current ratio is current assets over current liabilities. They can only cover 80% of their current liabilities with their current assets. And their current assets are $16 billion of cash, $4 billion of receivables, and $5.5 billion of inventory. The company should have enough cash to run its business over the next 12 months without taking on any more debt because they did have $15 billion of free cash flow, but negative $5 billion of working capital. They also have to pay an $8 billion dividend payment. The best way to look at ratios is to compare them to similar companies. The only other companies I did in this industry were Coty and Revlon. And Procter is in the middle. If they have a number in red, they're worse than the average. If they have a number in green, they're better than the average. So it looks like they're worse than average in PE, but that's because the other two companies have negative PE. They both have negative earnings. They're also worse than average in price to sales and price to book. They're the only company with below 1 current ratio, but they have a good ROE at 29%. They're lower in debt than average, and they're by far the biggest company of this group. They're the only company of the three that pays a dividend. So to summarize, I have them trading at a 17% discount. This is a giant of a company that makes products that everyone buys and everyone knows. So they're definitely not going anywhere. This is a great long-term stock. And the most important part is they have really strong revenue and really strong free cash flows. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.